Index funds, mutual funds, hedge funds, ETFs. You've probably heard these terms thrown around everywhere, but what do they actually mean and which one makes sense for you? In this video, I'm going to break all of them down in a simple, practical, no confusion way. We'll start by explaining what a fund really is, then walk through the main types, how they're run, the risks involved, the fees you pay, the strategies behind them, and most importantly, who each one is actually for. Give me a few minutes and I'll save you years of trial and error. What is a fund? Before we compare different funds, let's make sure we're on the same page about what a fund actually is. Imagine you and a group of friends are planning a big birthday party. Instead of one person paying for everything, everyone chips in a small amount. With that shared budget, you can afford food, drinks, decorations, music, the whole experience. No one carries the full burden and everyone benefits. That's basically how a fund works. A fund collects money from many people and uses that pool to invest in multiple assets, like stocks, bonds, or real estate. Rather than managing dozens of investments on your own, the fund does the work for you, and you share in the overall results. Now that foundation is clear, let's look at the different types, starting with the most talked about one online: index funds. You've probably heard people say something like, just put your money into an index fund and forget about it. But what does that actually mean? An index fund doesn't try to outsmart the market. Instead, it simply copies a specific group of companies known as an index. So what's an index? Think of it like a snapshot of part of the market. For example, the S&P 500 is an index that represents 500 of the largest and most established companies in the U.S. Bigger companies carry more weight, so their performance matters more to the index. When the S&P 500 goes up, it usually signals that the overall market is doing well. There are indexes for almost everything. Tech-heavy indexes like the NASDAQ, which includes companies like Apple, Microsoft, and Amazon. Industrial-focused indexes like the Dow Jones, tracking 30 major companies across different industries like Netflix, Meta, and Costco. Indexes for small businesses, international markets, emerging economies, and even specific sectors like healthcare or energy. The key idea is this: no stock picking, no guessing. Index funds are passively managed, meaning there's no manager actively buying and selling. They just follow the index. And that's actually a big advantage. Because there's less management involved, fees are extremely low. Most index funds charge an annual expense ratio somewhere between 0.02% and 0.20%. On a $1,000 investment, that could mean paying just a few cents to a couple of dollars per year. Major providers include Vanguard, BlackRock through its iShares funds, and Fidelity. Index funds are also considered relatively low risk because your money is spread across hundreds of companies. If one company performs poorly, it usually doesn't destroy the entire investment. One important detail many beginners miss: index funds don't trade in real time. You can place an order during the day, but it won't execute immediately. Instead, all trades happen at the net asset value, which is calculated once per day after the market closes, so you won't know the exact price until the end of the day. For long-term investors, this usually isn't a problem, but it's good to know. So why are index funds so popular? Low cost, low effort, strong long-term performance. That's why many experts, including Warren Buffett, recommend them for most people. Consistently beating the market is extremely hard, and index funds don't try to do that. They just match it. Mutual funds. At first glance, mutual funds might sound very similar to index funds, and in some ways they are. They also pool money from many investors and spread it across different assets. The big difference? Management style. Most mutual funds are actively managed. That means a professional manager or even an entire team is constantly deciding what to buy and sell in an attempt to outperform the market. The goal is simple: beat a benchmark like the S&P 500. That sounds appealing, but there's a downside. Active management usually means higher fees. Mutual fund expense ratios commonly fall between 0.5% and 1.5%, and sometimes even more. And despite those higher costs, research shows that most actively managed funds fail to beat the market consistently over time. Still, some investors choose mutual funds because they trust a particular manager, want exposure to a specific region or sector, or prefer a more hands-on investment approach. Large mutual fund providers include Vanguard, Fidelity, and JP Morgan. Some of their funds are actively managed, while others are passive, so it's important to know what you're buying. Just like index funds, mutual fund trades are processed once per day after the market closes. Hedge funds. Now we move into a completely different category. Hedge funds are not like index funds, mutual funds, or ETFs. Despite the name, hedge funds today are less about reducing risk and more about seeking aggressive returns. They're private investment vehicles that pool money from wealthy individuals or institutions. Hedge funds can invest in almost anything: stocks, bonds, real estate, currencies, derivatives, and they often use advanced strategies like short selling, leverage, borrowing money to invest more, and complex financial instruments. Managers have a lot of freedom, which means potential for very high gains, but also very large losses. Because of that risk, hedge funds are typically limited to accredited investors, people with high income or significant net worth. And the fees are famously high. The traditional model is 2 and 20, a 2% annual management fee plus 20% of the profits. That's far more expensive than index funds or mutual funds, which is why hedge funds aim for much higher returns to justify the cost. Hedge funds are not designed for the average investor. ETFs, exchange-traded funds. Finally, let's talk about ETFs. ETFs are often described as a mix between index funds and individual stocks. Like stocks, ETFs trade throughout the day on an exchange. You can see their price in real time and buy or sell whenever the market is open. Like index funds, ETFs provide diversification by holding many assets inside one product. Most ETFs are passively managed and track an index, sector, or market. ETFs also tend to have low fees, often lower than actively managed mutual funds. Expense ratios typically range from 0.03% to 0.75%, depending on the type of ETF. If you want exposure to something like the S&P 500, you can choose either an index fund or an ETF that tracks it. ETFs also tend to be very accessible, and many can be traded with zero commission on modern brokerage platforms. Final takeaway. For most everyday investors, index funds and ETFs are usually the best option. They're affordable, easy to understand, and offer broad diversification, making them ideal for long-term investing. Mutual funds can make sense if you believe in a specific strategy or manager, but higher fees and inconsistent performance are important trade-offs. Hedge funds are built for wealthy investors who are comfortable taking on more risk and paying higher fees for the chance at higher returns. That's the full picture: clear, simple, and practical. Understanding these terms is only the starting point. The real question is how you actually put them together into a portfolio that makes sense for you. If you want to see how this looks in practice, I've linked my ETF portfolio below. It shows real performance and breaks down exactly how I apply these ideas in the real world. If this video helped clarify things, consider liking the video and subscribing to FinEd for more straightforward investing content. Thanks for watching, and I'll see you in the next one.